We've heard a little bit of talk today about behavioural finance. Certainly one of the common feedback issues from last year was that you'd like to hear more from us on this topic. Now, at Morningstar, we have lots of data and lots of research, as you know. One of the things that we also have is a team of behavioural scientists over in the US that do a lot of research and increasing a lot of information and churning of data to really bring to life some of these emerging areas that are of particular interest around investor behaviour. Now, one of the data points that we've been really doing a lot of work on in the US for many years, and more recently trying to look at this around the world, is what we call investor returns. And so we're going to sort of explore what that is, what that means, and how that sort of can capture and look at the behaviour of investors out there. Now, when a few people saw the title of my presentation today and looking at the agenda in the last couple of weeks, the first reaction I got was, are you telling us about a tube in London, which I seem to have gone past. There we go. But I'm pleased to say that no, I'm not taking us to London to give you advice on how to board the train. We can do that another time. But what we really want to talk about is the gap that we want to mind is what we're doubling the behaviour gap. The difference between the investment total return that we're used to seeing that is fed through all the data feeds usually provided to you by us, through fund manager fact sheets, through your platforms that we're most familiar with, and comparing that against what we call the investor return, i.e. what is the actual return experienced by the typical investor within that fund? Because we all know one of the vagaries of looking at just trailing time-weighted returns is that it assumes that you invested a lump sum exactly 1 year ago, 3 years ago, whatever the period was, and you held that for that entire period and then sold yesterday, essentially. Now, we all know in reality that that's basically true for almost nobody, and that at an individual investor level, people are buying and selling all the time of different things. And so the experience that they're getting or achieving in their portfolios can often be quite different. And so to the extent that we can look and measure and quantify the differences between these two is what we're dubbing the behaviour gap. So, anecdotally, we know that investors have a tendency to chase performance, but I think the big issue for all of us is how do you quantify that? How do you prove that in order to therefore have a sort of more realistic, forthright conversation with your clients about keeping this sort of issue in mind about market timing? So, what is the investor return? As I've sort of alluded to, it calculates fund returns on an asset-weighted basis rather than a time-weighted basis. So as I said, most of the data that we're used to looking at when looking at investment fund performance is done on a time-weighted basis, assumes you invested lump sum at the start, held it the whole period. But when we look at the performance of funds through an asset-weighted basis, one of the cool things we can do with the data we've got at Morningstar is take into account the effect of flows in and out. We're obviously capturing the asset levels of funds through time as well as just the unit prices and performance. And so what we're able to do therefore is to account for the difference that those inflows and outflows make in any given fund, the effect that the compounding of that has over time, and therefore more realistically capture, measure and quantify the experience of the typical dollar invested in a fund at any given point in time. So that's the theory. Let's bring this to life with a real life example. What you're looking at here is a real actual fund. The blue line there, starting 10 years ago, 2007, is a standard growth of 10,000 chart that you have seen many times. Fairly common pattern overlaid with that is the monthly inflows or outflows. So you can see the green bars above the line represent monthly inflows, the red bars beneath the line represent monthly outflows, and sort of all too familiar pattern here. You can see a fund that has actually performed very well in the lead up to the start of this period and continued to do so for probably the first 6 to 12 months there. Sure enough, money's piling in just in time for 2008 to occur. Fund materially, not only the market falls, fund significantly underperforms as well. As we see the blue line draw down, money runs for the exits. Just in time, of course, for 2009 to kick on, we see a sharp rebound that lasts for the best part of the next 8 years, but most of the money's gone, people have given up. You can see fairly negligible flows the rest of the time through there. And so over that 10-year period, if you were looking at your standard data feed, your standard fund fact sheet, that fund would tell you that over that time period, the return for the fund was 3.9%. when in actual fact, the typical investor who'd been in that fund during that period and came and went at different times, usually at the first couple of years there, as we saw in this case, their experience was actually negative 15.4% annualised over that time period. Now, I've clearly chosen a fairly extreme example to demonstrate the point here, but I think this is probably an issue that I think all of us, sitting in front of clients day in, day out, realise that when we're getting much of the performance information fed through, it doesn't necessarily always, from a fund or portfolio level, translate to what the end investor has experienced in their own portfolios. And so the way that we can analyse this and capture this data and really start quantifying and therefore having a meaningful conversation with clients to bring this to life and factor it into our decision making, we think is becoming increasingly important. Because you can look at individual funds in isolation like that, but what becomes even more powerful and more telling behind the story is when you sort of aggregate this data in groups. And so this is just some US data. The first time we ran this a couple of years ago, couple of patterns emerge. In international equity funds, we're seeing on average over that 10-year period a 3% gap between the sort of average reported return of all the funds in that category. This is a large universe, US domiciled international equity funds. This is not a small sample size. On the bond side, similar story, smaller magnitude, but still quite meaningful difference between the typical experience of a unit holder in those funds versus what would typically be reported through our general ways of calculating and reporting on fund performance. So, as we analyse this data, we look at it across different time periods, different markets, different sectors, there's a few common patterns that emerge. Generally, investors are bad at timing. They buy and sell at the wrong time, I said at the start. I think anecdotally most of us know this, but actually being able to sort of quantify this to have a more meaningful conversation, we think is really important. So what we've dubbed the behaviour gap, the gap that we want you to mind is really the difference between these two. One of the interesting things that really sort of consistently emerges in most of the data sets across asset classes, across markets, is that these gaps tend to be larger the more volatile a fund or a broad category is. And so you noticed on the previous slide, the equity gap was larger than it was for the bond gap. And that's fairly consistent through time. So the most recent cutting of this data on the US side, you can see some differing levels of gaps there. But if we look at domestic, local US equity funds, 74 basis point difference. On the international side, over this subsequent period, the gap had narrowed, but was still over 100 basis points. On the bond side, you're seeing there 82 basis points. The interesting one there that really stands out as being fairly narrow is in the allocation, or what we would here know as sort of your traditional multi-sector, diversified or balanced fund. The type of fund that's typically in a sort of auto investment plan, a regular savings plan, often a default super type of allocation, where less prone to behavioural elements, people just auto-allocating every fortnight, every month, every quarter, whatever it is. And that's being borne out in the data. There's less of a behavioural impact there, and investors in those types of funds are capturing more of the actual return that's on offer and not giving it up like they are in some of the more volatile areas from poor timing around buying and selling. We flick to Europe, similar sort of pattern. You can see there, in this case, some of the gaps were narrower. 40 basis points over this particular 5-year period in Europe recently. Interestingly, where one of the larger gap appeared was in alternatives. Certainly an area in the last 5 years that's right around the world people have been embracing more and more. Two things to me stand out on that graph. A, the total returns in the first place haven't been that exciting and lived up to expectations. And secondly, people are haven't really worked out how to use them appropriately and capture what is on offer. And so, what does that mean for Australia? So, as I mentioned at the start, this is an ongoing body of research that we're doing right around the world, and specifically for Australia. Some of our preliminary findings on this is that in the last 5 years, we've actually seen some positive gaps in the market. Now, that's a bit unusual, but it isn't unprecedented. Certainly in market environments or particular time periods where you've had generally rising asset values across most asset classes, as we have had from 2012 through the end of 2016, where this particular data goes, we've observed some positive outcomes. Now, if you fast forward or even rewind through periods of market stress where this tends to become more of an issue, certainly that's an interesting area where we will be monitoring and seeing if there's any changes in that. So it does highlight the time period dependence of some of this research. But probably the one notable thing, and this goes to my comment around the allocation funds, is that the one pattern that really stood out locally is that superannuation funds generally had better outcomes, than discretionary investment funds. And again, comes back to think of the behavioural elements of that. Super funds, less active buying and selling, more regular contributions. And so that's, again, being reflected in the data that we're seeing and observing here. And that's a common pattern we've observed right around the world. So it's particularly stood out with some of the 401k share classes in the US, as well as some of the regular savings vehicles we have up in Korea. So this is an area we're doing more and more research on. We think it's an important part of a discussion increasingly to have with clients, understanding the different behavioural elements, how different types of funds can be more prone to poor behaviour. But the good news is you can actually already see those for the individual funds you're using here in Australia. So this is just a snapshot from the performance page of our fund research reports, where you can see in the middle there, we're already publishing the investor returns alongside the total returns for each fund that we're publishing research and analyst ratings on. So I'd encourage you, when you go back to your offices, as you're looking through our research, there's many data points on our reports I am very conscious of, but it's certainly one that hopefully have given you a feel for today, and maybe one you can start to factor into your conversations, particularly where you're looking at funds that are more volatile, that are more up the risk spectrum, and that do therefore have a high tendency to be used and inappropriately bought and sold at the wrong time. So, key takeouts then, big part of this is, we're all in the behaviour modification business. Whether we're an advisor, whether we're a fund manager, whether we're a researcher, trying not to recommend the latest, greatest thing that's done well recently. As much as we all try to avoid it, how many times have you heard someone justify, we want to include this new investment because it's done really well in the last year, the last 3 years? Looking past having more fundamental basis behind our decisions there, because in the long run, the amplifiers of that sort of behaviour will lose out. But the temptation, of course, is in the short run, amplifiers can make a lot of money as you get momentum along the way. So if we take a long-term view that amplifiers are going to lose, if the investor therefore doesn't win in the end, we're all going to lose. So really sort of to encourage you all to think about this issue, about the types of investments and certainly the timing of investments and why you're choosing those. And so that is the end of our presentation today.